We're recording now. So, members of the Lechna Fellows cohort of 2018-2019, Happy New Year. It was great to be with you all last week. Tim's on, so we can all say our greetings to him. He survived the marriage of his daughter, and life is good, and he's blessed, and his family's blessed. So that's as good as it all gets. We are honored to have Susan Scroggins with us today. Susan is the Senior Vice President for Finance and Treasurer of the Board of Valparaiso University. In this role, she serves as the university's Treasurer and Chief Financial Officer. And she also provides leadership to a number of other functions there at the university, as well as the board, as I mentioned, Treasurer of the Board. Prior to coming to Valpo, Susan held a number of financial positions, leadership positions in manufacturing and retail, serving as the Vice President and CFO for Viking Engineering Incorporated, and also as the Controller for Welsh Incorporated. Like all of us, we have our professional organizations, so she is an active member of the CACUBO, Central Association of College and University Business Officers. And are you still serving as the second Vice President?
I'm actually president this year.
Woohoo! So she's
very busy. Yeah.
That's congratulations or deepest sympathies.
Yeah, right.
She also serves on the boards of the Porter County United Way and Thrivent Financial Mid-America and is a member of the Valparaiso Kiwanis. Susan did our presentation last year and it was a great job. And Susan, you had the floor.
Thank you. Thank you. Thank you all for having me back again. I appreciate the opportunity. And I hope I'll serve you well and actually have an opportunity to maybe inform you over and above whatever you've been reading. Tom, are you still using the same text that you used last year, or are you using a different text? Just curious. Sorry, I shouldn't have unmuted you. We'll go on.
Yeah.
What's that?
I said, we use it. They're not sure we're using it.
Oh, okay. All right. Regardless. But my intention is to provide a really very high level overview of finances in higher ed. And if there are questions along the way, I encourage you to ask them. If I get bogged down in terminology that I'm not explaining well enough, I encourage you to ask questions. If you have additional insight to offer, I encourage that as well. So with that, we'll go ahead and just get started. In terms of the topics that I wanted to cover today, you can see in front of you, again, a top-level financial statement review. And we're in a kind of a different time period right now because we have new accounting standards that became effective this year. So on your campuses, you're likely to see a different statement for fiscal year 19 as opposed to what may have been issued recently for fiscal year 18. We're going to talk through some of the nuances of that as we go through the slides today. We'll take a look at some composite financial measures, external reporting considerations, and then finally actually offer up some resources this year for you and your institution as you think about the financial sustainability of your organization. This is one of my most favorite quotes, and if you're in higher ed or another nonprofit organization, this might resonate with you as well, but I just wanted to share. The nonprofit institution neither supplies goods or services nor controls. Its product is neither a pair of shoes nor an effective regulation. Its product is a changed human being. The nonprofit institutions are human change agents. Their product is a cured patient, a child that learns, a young man or woman grown into a self-respecting adult, a changed human life altogether. Again, just one of my favorite quotes that anytime I do a presentation, you're going to find a quote in it. So that's the one for today. Again, high level, simply stated on the financial statement side. And then in the first couple of slides, I wanted to provide a little bit of context for you. So this first slide entitled Moody's Investor Services. So Moody's Investor Services is a organization that provides credit ratings for institutions that are seeking to borrow money for projects. So on our campus, most recently we did that in 2017 to borrow money to finish a science building on our campus. And so what the credit rating does is provides reassurances to the potential purchasers of the bonds that the institution is in a good position to repay the monies to them that they've invested in. Moody's annually issues an outlook for various sectors, and for the higher education sector, they've been pretty negative for the past few years, and no different today. So the most recently issued outlook was on December 5th of 2018, and they again remain negative and primarily related to low tuition revenue growth. And we're going to talk about some of the dynamics that are impacting that low tuition revenue growth as we go through the slides. And maybe on your campus, you're very well aware of that, and maybe not, and we'll talk through it regardless. They point to the fact that increasingly expenses will outpace constrained revenue for most colleges and universities. Primarily driven by rising labor costs. Higher ed's a very labor-intensive sector. 65 to 75% of expenses typically are incurred at higher ed institutions of higher education. They'll remain the largest hurdle going forward. They think that privates will fare better than publics. They do actually lift up one plus. They do point to the fact that higher ed, particularly those institutions that have endowments, have been able to amass pretty healthy reserves related to the endowment earnings, endowment growth over the past, I'd say the past 8 years or so. So again, strengthening those endowment payouts at the end of the day. So that is a plus, but again, their outlook remains negative. And just as a reminder, or maybe new for you, a Moody's institution rated A is the top of their scale. They typically attach an outlook to your rating as well. So you can be rated A1, A2, A3, with either a stable or a negative outlook. So two things to pay attention to there. The other piece, again, just to sort of provide some context before we move into the statements themselves, is this, what I referenced earlier, FASB, or the Financial Accounting Standards Board, has issued new pronouncements on financial reporting standards that are effective this year. There were some early adopters, but my guess is that your institution's Valpo was not an early adopter. We delayed it as long as we could. We have a specific reason for doing that, but this is the first significant modification in these accounting standards in over 20 years. So the last significant rehaul was in 1993. It was FASB 117. The intention behind the new standards was to simplify and improve how net assets are reported, and then providing additional disclosures on liquidity, financial performance.
Hi, Susan. Has anybody else had her freeze up?
Yeah, she's frozen for me.
Yeah, I'll send her a note to the email.
She started talking about liquidity and everything froze up.
Yeah.
That's how it goes.
Isn't that the way life is?
I think you're on mute still.
Tom, sometimes it helps if people turn off their videos.
Yeah, she's coming back.
Is that stop video, Diana? Is that what I?
No, that's actually what we're seeing is her screen still.
Right, but Yvonne, yes, it is stop video.
Okay, so I'm still here?
Yes.
Right.
Okay.
Hey, Susan.
Yeah. Am I back or no?
Oh,
You're
yeah,
back.
you are. And so we're all just laughing because as soon as you started talking about liquidity,
I went away. Oh, not good. Not good. Not good. Okay, let me see if I can get back and swing. Okay, am I still good?
Yeah.
All right.
So
Okay.
the slides are not up yet, though. So
Oh,
you might want to take a look at share again. And we're having everybody turn off their videos. So they're
okay.
going to stay there on voice, their side of the video. They should still be able to see yours.
Okay. I do not. Let's see. Let's do one more thing. I don't have a share button, Tom. Let's see. I'm gonna go one more thing.
So if you take your cursor and take it to, let me just make sure you're still on as, well, yeah, it's still showing you as co-host. So if you take your cursor or arrow and just move it towards the top or bottom,
Yeah.
nothing shows up.
No.
Well, go ahead and talk through it, and then we'll see if after a little bit it comes back up.
Okay. I could also send this to you.
Okay, perfect.
And you can, and if you want to send it to others and they can follow along, is that helpful?
Perfect.
Okay, all right, let me take a minute to do that.
Actually, if I get it, I'll put it up.
Okay, yeah, there you go. And I can tell you when to flip the page.
Oh, by the way,
Yes?
so let me just see how long it takes, how many milliseconds it takes to get an email from Valparaiso.
Yeah, it hasn't sent it yet, hold on.
Okay.
Hold on, we'll get there. Okay, almost got it here. Hold on.
Perfect.
Here we go. Okay, hit the send button.
Okay, I'm looking. Wouldn't it be interesting to know where this email all goes?
Yeah.
It's not that interesting.
Thanks, Phil.
Somebody knows.
Oh, come on. Of course, when you want something to travel quickly, it's not going to do that, but we're doing fine time-wise. So why don't you go ahead?
Keep talking.
Yeah, go ahead. And
Okay.
then as it gets up, I'll load it.
All right, sounds good. So we're still talking about the FASB accounting standards, and we'll just, I mentioned that the assets are going to go from 3 categories to 2. And then it started talking about in terms of liquidity, we have to add disclosures to the financial statements, both qualitative and quantitative. And so from a qualitative perspective, we have to disclose how our institution manages and monitors liquid resources. And then from a quantitative perspective, they're looking at, how liquid are you? So how much do you have in cash and investments and other assets that are easily turned into liquid assets. So that's a new piece. And actually, the FASB is catching up a little bit to Moody's, because previously Moody's has already added a liquidity disclosure to their annual filing. So, and then finally, expenses are going to be reported in 2 ways going forward. Typically on our financial statements, we report by nature, which includes salaries, benefits, utilities, descriptions like that. But what we'll also need to disclose going forward, and we do this in the footnotes, but it's not a requirement currently, is actually to disclose these expenses by function. So those are sort of those classifications that include instructional costs, academic support, institutional support, similar what you see on IPED's reporting. So those are the two pieces I wanted to share before we get into the statements of financial position and statement of activities. So those are the two documents we're going to spend the most time on. The statement of financial position is also known as a balance sheet outside of higher ed. It's a snapshot at a point in time. So what that means is, for instance, typically that balance sheet has measurements as of a certain date. For instance, June 30th, 2018 is our year end. So in our audited financial statements, it includes balances as of June 30th. Audited statements also include an auditor's opinion regarding the statements. You're looking for an unmodified opinion on the financial statements. That's a quote clean, unquote clean opinion on the statements. And really the auditors are only engaged to opine on the financial statements themselves. This is sometimes people misunderstand what the purpose of the annual audit is. It is not to an audit to uncover fraud, although fraud is sometimes uncovered during the course of reviewing the financial statements. There's typically 2 years of information presented in an audited statement for comparison purposes, and then throughout the presentation you're going to see some reference, some red highlighted items, just some sort of key points and to hit home on. So on the statement of financial position or balance sheet, what you're looking at are assets, which are what you own, minus the liabilities, which are what you owe, and that equals your net assets. So that's a very basic accounting formula, and it really entails what's captured on the balance sheet. And again, there's that reference you see on the final bullet point: net assets equal the sum of unrestricted, temporarily restricted, and permanently restricted net assets, which is what you'll see in 2018. Again, moving just to those two categories, they're either unrestricted or they're restricted. And we're going to drill down a little bit more.
Just
so
real quick.
Slide. What's that?
Can you see the statement of financial position now slide?
I do, yeah. So you can go ahead and advance to the next slide, please.
Okay.
Oh, wait a minute. No.
Did I go too far? There you go.
Yeah, there we go. Assets, cash is king. So we're going to drill down a little bit more on what those assets entail or what those liabilities entail, what's being captured. So on the asset side of the equation, again, the things that we own, cash is king. So when I teach my MBA courses, I try to drive this piece home, because at the end of the day, whether it's a nonprofit or a for-profit institution, when an institution runs out, or a company runs out of cash, that's typically the end for them, right? So cash is king. In higher ed, cash is cyclical too. So depending on your billing and collection policy, here at Valpo, we are cash flush at the very beginning of a semester, because we require our students to either have paid their bill in full or have a payment plan in place. And then we receive payments throughout the semester. But again, flush with cash at the beginning of the semester. In June, it becomes a little more tricky, right? Because both of your semesters are done, and now you don't have as much, or we don't have as much income coming in the summer, yet you still have a lot of fixed costs that are going out. Investments are captured on the statement of financial position, including your endowment. The performance, the balances on your investments, they're market driven, and also campaign driven. So if you're in the middle of a campaign, you'll see that investment line item typically move upwards. Receivables are captured. These would be things that are owed to you from students through the billing cycle, or from donors and pledges receivable, donor gifts that are due to you. And again, those will sort of ebb and flow depending on your policies and whether or not you're in a fundraising campaign. If you're in a fundraising campaign, you tend to see those numbers tip up a bit. And then the final bigger piece, typically on a statement of financial position, would be property, plant, and equipment. So this is everything from the buildings that we teach in, to administration buildings, to the furniture and computers and technology that we need to deliver our programs. On the liability side, typically notes and bonds payable are the biggest pieces there. Accounts payable are your day-to-day activities that haven't been paid yet. Pension healthcare liabilities, those are things that we keep an eye on. That will depend too on your own university's policy in terms of pension liabilities. We don't have those here. At our university, we've moved to a defined contribution plan, or a 403B plan, as opposed to a defined benefit plan. A defined benefit plan is typically when you see pension liabilities on a financial statement. And then the final little piece there, we actually have to record asbestos liabilities too. So those, you don't see the term asbestos, but if you see a term that something to the effect of conditional asset retirement obligation, that is represents the amount of money that it will likely take you to clean up the asbestos issues you might have on your campus. So if you've got a newer campus, you likely don't have a very big number there. If you have an older campus, you likely have a liability for asbestos. On the right-hand side of this page, you see a couple of red text pieces. On the first one, things to watch. So on the asset side, you want to watch for decreasing balances without plausible explanation, particularly cash and investments. So, an example, in an up market, if you see your investments dwindling, you should call the question, why would that be? It doesn't make sense, right? It's all about, does it make sense? The second watch is increasing balances without plausible explanation on the liability side. So why are liabilities going up? Typically, again, you'll see it on the notes and bonds payable piece, but if you all of a sudden see a big pickup on asbestos or pension liabilities, then you should probably call the question. And there's a typo here. That second, and when I send, well, you already have it, but the second watch that says particularly cash and investments should say particularly notes and bonds payable or pension liabilities. Sorry about that. Okay, next slide. We're still in the statement of financial position. This is the third piece. We have the assets, we have the liabilities, and then we're left with the net assets, which is the difference between the two. And again, this piece is changing to two categories going forward. Currently, they're classified as unrestricted, so these are retained earnings over time. They're unrestricted as to purpose. And then temporarily restricted, this is really the piece that's going away. The temporary restrictions could be through the board, through a donor, restricted by action or time. This is where endowment earnings were captured previously. And then on the permanently restricted side, that's where the original endowment gifts are made to the endowment. So, and sometimes you hear this referred to as the corpus. So this piece is typically not spent, although MIFA guidelines do allow spending into that original gift. The more prudent policies limit that spend into that gift so that you can maintain this last thing, intergenerational equity, so that you're not spending down into that gift at the risk of jeopardizing what you might be able to pay out in future generations. That's the reference to intergenerational equity. And again, watch declining balances in any of these categories without plausible explanation. Next slide, please. All right, so we're done with the statement of financial position, or the balance sheet section. Again, that was a snapshot at a point in time, and we're moving into the statement of activities. And again, outside higher ed, these are sometimes referenced as profit and loss statements, or simply a financial statement. this measures performance through a stated period. So you may see a financial statement, typically an internal financial statement that measures, say, the first quarter of your fiscal year. So in this example, I've said for the period ended September 30th, 2017. So what we're doing there is capturing 3 months of activity. But more typically what you'll see again on the audited statements is a reference to for the year ended June 30th, 2018. And so what we're doing there is capturing 12 months of activity. And those activities include both revenue and expenses. And we're not going to drill down into this too much. Let's go ahead and go to the next slide, where we can get into more of the details. Again, still in the statements of activities. On the revenue side, of course, the biggest piece will be your net tuition revenue. So most of our institutions are very tuition dependent institutions, meaning that we earn most of our revenues through tuition and fees. Gross tuition would be the measurement of that, whatever your sticker price is, multiplied by whatever, the number of students you have, how many students matriculated. This is very much influenced by demographics, which we're going to talk about in just a minute. Some challenges for institutions of higher education. Program demand, we need to watch cyclical trends. I think institutions that have medical schools, that have engineering schools, probably are doing all right. Those particular sectors, we see good demand for nurses, physicians, and things like that. So you need to watch those cyclical trends. Make sure you're offering programs that are in demand, or in terms of to be able to drive those revenue numbers. The offset to gross tuition is that financial aid number. Funded aid is a wonderful thing. That means that your endowment or some other source is throwing off support of scholarships to your institution, so that money doesn't come out of your revenue or out of your expense budget. Unfunded aid is another story. And again, here we're seeing lots of pressures on colleges and universities to discount a gross tuition, and that many times means an increase in unfunded aid, and we'll drill down into that a little bit as well. Auxiliary revenue is becoming more important to colleges and universities as there's pressures on net tuition revenue. These are your room and board revenues that are received, camps and conferences, anything outside of that net tuition number that can help boost revenues to the institution. You'll see endowment support is reflected on the statement of activities. And then finally, another big piece could be private gifts and grants, again, depending on whether or not you're in a fundraising campaign and the generosity of your donors. The watch here, declining revenue trends, again, without plausible explanation. Next slide, please. So here's where we'll talk a little bit more about those challenges that maybe you're pretty well versed in, maybe not. The U.S. Demographic piece. Again, after 15 years of consistent growth, and we'll show you a chart in a minute, we're in the midst of a decade of a declining number of U.S. high school graduates, causing really increased competition for students across the U.S. But I will tell you that the Midwest and the Northeast states are experiencing the greatest declines, and therefore are feeling probably that increased competition to a greater degree than maybe the West Coast and Southern institutions. There is an increase that's expected again in 2025, but seems like a long way off to me right now. I can tell you that. Those Southeast and Southwest states, that growth is likely due to more Hispanic and Asian Pacific Islander students that would matriculate. Let's go ahead and go to the next slide. So here's a picture of what I just tried to convey to you. You can see between 1995 and 2010, 2011, that really that growth in the number of high school graduates across the U.S. And then you see 2015 to 2025, kind of stagnation, a fall off in the number of high school students that are going to be matriculating to colleges and universities. And I think it's really interesting that that low point there between 2015 and 2020 is what we're feeling right now at most of our institutions. And then you see that 2025 pick up again. And then what's, I think, even more frightening to me is what is projected post 2025 to 2030. Again, increasing that competition amongst our institutions. Next slide. This drills down just a little bit more on a statement I made a little bit earlier. This is high school graduates by race and ethnicity. And so if you just focus on the blue and the green pieces of this particular graphic, you can see in the green that reflects the growing Hispanic population trend. And in the white, you can see that tightening and the decline in the white high school graduates. And so we need to think about this, I think, very thoughtfully as we look to the future in terms of how we attract students and efforts that we make to retain students that we might not necessarily be very good at doing at this point in time. So just another little piece. Let's go ahead and go to the next slide. This is the other piece that is challenging and probably influenced by the increased competition for students. This is from the NACUBO tuition discounting study. I think there's one more that comes in after this that's not reflected here, but the trends are the same over time. You can see that gradual increase in tuition discounting rates over time. I'd sure like to be back in 2006 when our discount rates were only 38%. And I can tell you there are many institutions that are in the 60s and approaching 70% in terms of tuition discounting at this point in time. So again, really a lot of pressures on those top level revenue resources in terms of tuition and fee revenues. Next slide, please. So those were the revenues with a little bit of color added to that. On the expense side, on the statement of activities, again, composed primarily of compensation, which includes both salaries and benefits, about 65 to 70% of total expense. Benefits typically run around 30%. We're a little higher than that. We've had a couple of years of really challenging healthcare trends here on our campus, and it required us to make some pretty drastic changes in the plans we offer and make some adjustments to employee contributions as well. So that one, as we all age and as medical technology produces all sorts of opportunities to extend our lives, I don't see any relief on that healthcare line item going forward. This is also where we capture, facilities, utilities expenses. If you're primarily a residential campus, here at Valpo, we have a 3-year residency requirement. So freshmen through junior year, our students are required to live on campus. So as you can imagine, that does drive our facilities costs and utilities costs. Lots of repair and replacement. We have old residence halls on the north side of campus that need constant attention. We have some newer ones, but those aren't the ones that give us fits typically. I have a reference here to capacity and space studies. I think that many of our institutions are likely have plenty of capacity to handle more activities, whether they be related to our main mission of educating students or opportunities to lease space to maybe complementary businesses or somehow utilize all of our capacity in our spaces. A reference to utility contracts, if there's an opportunity in your area to collaborate on those, I highly recommend. Those have saved us thousands of dollars over the years. Statement of activities, depreciation expense. This is where depreciation is captured. Depreciation, if you're not familiar, that's a methodology to take an asset that's going to last you, say, 60 years. So a new residence hall, depending on how it's built, could last you 20 years, could last you 100 years. But the idea is you take the expense for building that particular facility over the expected life of that asset. So rather than capturing $10 million of expense in the year, say, a residence hall is built, the expense for that facility is taken over a 20, probably to 40-year a period to match sort of the use of that building over its expected life. There's a reference to EBITDA there. That's a measurement we capture here. That if you hear that, that's usually a measure of operating performance outside of decisions you make regarding capital investment and financing decisions. Well, what does that mean? It's really, it's capturing that operating performance before adding in depreciation. So those would be decisions you've made on capital investment and interest. So those would be those decisions you've made about financing those capital investments. So it's just another key measure that we watch over time. Next slide, please. And then finally, a reference to don't forget the statement of cash flows and the footnotes. The statement of cash flows is just that. It gives you a better sense of the cash flowing in and flowing out of the institution. And you might scratch your head and say, well, can't I just get that from the statement of activities? The thing to remember here is on the statement of activities, you're using that matching principle. So there are accrual. It's an accrual-based accounting system that may or may not match your cash flows depending on your accounting policies and your fiscal year end and a number of other things. But again, sources and uses of cash are much clearer on the statement of cash flows. And then finally, the footnote disclosures. Again, when I teach my MBA students, I say, this is really where a lot of the good stuff is. It can be intimidating when you flip through a financial statement, though, and you see all this verbiage at the back, and you wonder what's going on there. But there's where you get a lot of the details behind what's going on at the institution. In addition to accounting policies, there's more detailed information on how endowments are invested and what those returns look like. There's more information on long-term debt. How many times have you borrowed? Who do you owe? How much do you owe them? And, just really useful information, including any pending lawsuits. Now, the key here is attorneys and auditors use the terminology material. So unless the lawsuit that your institution is entered into is material in nature, meaning it's likely to have a major impact on your institution, you won't see anything here. But outside of higher ed, many times you'll see something listed there. And then finally, the auditors are, again, auditing a period of time, typically through June 30th, if that's your fiscal year end. There may be things that happen subsequent to the year end that really need to be disclosed to be fair to the reader of the financial statement. So an example of that would be the year, for instance, Valpo closed on a new bond issuance. So while we had entered into those activities in June, we didn't close until July, so it crossed over a year. So we reported that as a subsequent event to be fair to the reader. Next slide, please. All right, so now we're going to move on into, that was every, I wonder, well, maybe we'll save the end for questions. I'm not sure how you want to handle that, Tom.
Susan, it might be good how about questions now?
Good, that's perfect. I was going to offer that. I was just worried about the technology. I'd be happy to take questions now or comments.
But if I can throw in, if you take anything away from this, it's really the understanding that there's budget and there's cash flow.
Yeah.
And you need to understand both of those to understand the health of your institution. And it sounds weird, I know in the beginning, that, hey, I balanced my budget, but I don't have any cash.
Yeah.
And so
Yeah.
it's those two. And Susan, maybe you could comment on this. Well, there's two other things. One, some institutions do put depreciation in their budgets and some don't.
Yeah.
So that's interesting. And then what do you think, is discounting the major issue that's higher ed's facing right now?
Okay. So 3 things, right?
Yeah, so cash, everybody knows cash and budget, so you can skip that one. But
Okay, but I will make a point there. I mean, that could be something as easy as, what are your billing and collection policies, and are you sticking to them, right? I feel like I do need to make a comment here, because it's so easy. We all love our students and want them to be successful, and worry. But at the end of the day, and like to make exceptions to collection policy, at the end of the day, you got to bring that income in. And so there could very easily be a mismatch there in what you report as billed to a student versus what you collect. So that's the very basic form. You want to talk about depreciation or discount?
Some institutions choose not to put it as part of their budget.
Well, yeah, and that's kind of at the end of the day, it might not be part of your budget, but it's going to impact your audited, it's going to be there in your audited financial statements. And the idea there is depreciation is not a cash item. It's the amortization of cash that you've already spent over time. And so we have always tried to cover depreciation as a matter of course. And the reason being, if you're able to cover depreciation, theoretically, you have that funding available to reinvest in repair and maintenance of your facilities. So that's the upside, and primary reason we have done that, tried to do that over time. It's been much more challenging to do that in the last few years than it has been previously, but that's still a goal here. On the discount side, yeah, that's for us, yes, absolutely. That's a very real challenge. And we are actually, looking at a lot of things. We're looking at, how do you market your institution? What is the messaging that you are making to your students and your parents? Do they know that you have a 95% placement rate after the student leaves? Just little nuances, and what is the campus visit like? It's tough, and the piece of this is the number of institutions that are in your state or in your peer group or in your region. How many institutions are you competing with for a dwindling number or a stagnating number of high school students? It's really putting a lot of pressure on discounting. It truly is. Maybe I need to say something here too. At the most recent Kakubo annual meeting, there was a very good presentation by a young woman who actually did her dissertation on tuition resets. So previously, a tuition reset is where you take a look at your gross tuition, typically back off on that sticker price, in an attempt to push out messaging to students, hey, look at our sticker price as compared to the competition, right? And then you adjust your financial aid accordingly, so you don't, at the end of the day, lose money by doing this. But gross tuition rates, they are unsustainable, right? So our current gross tuition is $40,000. A young person looking at that, or a parent that's not aware that tuition discounting even goes on, might look at a sticker price and say, I can't afford that. How could I even think about applying to Valpo? So So there are, in terms of messaging, in terms of, so we're talking about tuition reset. So anyway, this young woman has done a study on, there are 45 institutions that have moved to a tuition reset over the past 5 years. Probably 10 to a dozen of them in the last 18 months. So it's becoming more of a trend than it was previously. But I will tell you, previously, an institution that moved to a tuition reset, some of the messaging was, that institution is in trouble, rightly or wrongly, right? I think that you were going to see more institutions do move to a tuition reset, and it's probably needed. So that was probably more information than you wanted me to share on that, Tom, but I felt like I needed to get that out there too.
And Concordia St. Paul, one of our institutions, has done a tuition reset pretty successfully. So it's worked for them for where they are. How about other questions from the group?
On the discount rate, question a little bit further. So I certainly understand why long-term continuing to cut the amount we're taking in is a challenge, but in a particular class, it seems like, if I'm oversimplifying, but if it costs you the same, whether you admit 430 or 450, or whether you have matriculate 430 or 450, aren't you better off getting some revenue from those 20 additional students than getting no revenue from them?
That's a great question. And the other piece that goes with that question is, and why not bring in that student at a lower discount rate so we can fill our residence halls, so we can ensure that our auxiliary revenue is maxed out? So it's a perfect question. And honestly, increasing discount rates has been a strategy. It's been a strategy for Valpo under one of our VPs for enrollment management. So if you're out on the leading edge of that and can grow, if you have capacity on your campus and can grow your student population, it absolutely is a strategy. The challenge is when you get to 70%-ish. When your discount rate is that high, it becomes more difficult to attract the number of students that you need for it to really make an impact. So that is an excellent point, and it absolutely is a strategy. You just need to be really cautious because you can't discount into oblivion. I guess that's how
and Susan and Stephen, discounting is an interesting strategy that can also be done very badly. And
yes,
part of the argument is it works if you have excess capacity.
Yeah.
You're not going to be able to get to those kind of discount rates and add faculty.
Right.
You're not going to have the capacity to do things like that.
Yeah.
And so this place I'm working now basically discounted themselves into a hole.
Yeah. Yeah.
And that also gets to Susan's other important part, is the collection process. We hate to send people to collections, but there are some times when people need to pay.
Yeah.
I sort of like this, and Stephen, this question about tuition reset really means to take your discount rate and reduce it by reducing your overall tuition so you become more marketable. So it's an interesting strategy, and you can talk to the folks from St. Paul about Concordia St. Paul and how that's worked at their place.
Yep.
Thank you for that.
Yep. Other questions before we move on? Okay, if not, I'm going to go ahead and move on into the next section. We got 3 more sections. These aren't as long as that first piece. That was pretty much the meaty part of the presentation or the conversation. But I did want to supply some information on what some of our external reporting sort of commitments are, the importance of financial analyses, and so on. So let's go ahead and go to the next slide. So what do I mean by external reporting? So folks in your business office or finance office are indeed working on the budget and working on your audit every year, but there are lots of other requirements of staff related to financial reporting. We're going to actually drill down a little bit more on this IRS Form 990. So as nonprofit institutions, we don't have to file a tax return per se. What we file is called an information return that has a lot of information on it. We're going to talk about that in a few minutes. You can actually obtain oodles of IRS Form 90s on GuideStar. GuideStar.org, just type in the name of any institution and you'll be able to pull that up. And again, in a minute, I'll show you the types of information you'll be able to obtain. There's also iPads. iPads is the system I love to hate. I have a thing with iPads. What I love about iPads is that they're probably, of all the surveys that we do, in my opinion, have the most common definitions. Sometimes there are institutional differences, but sometimes it's hard to look at survey data and really feel comfortable that everybody's used the same definition in what they're reporting. But I think iPads does a fairly decent, and because it's been in place for so many years. There's 12 interrelated surveys. My beef with iPads is the data is stale. You can't use it for comparison purposes if you're wanting to move forward in my view, a very meaningful way. It absolutely can serve as a data point, but it's a measure of history at a period of time 2 years ago. So that's my beef with that. You certainly can measure yourself year over year because and that is helpful. But if you're trying to compare yourself with other institutions, it's not so much. EMMA is electronic municipal market access. Any institution that has issued public debt is required to make disclosures on EMMA. And again, this is open to the public. So if your institution has outstanding public debt, you just log into EMMA, type in your university, and look under disclosures. So again, for instance, every year we are required to file our audited financial statement. And then there are probably 10 different sections of other data that we have to file, which include enrollment. It includes information on where students are coming to you from, what types of financial aid that you're offering your students, and things like that. So lots of really good information there. But again, all requires some really good effort on the part of your business and finance office. Next page. Again, I promised we'd talk just a little bit more about that example Form 990. And not sure if I drilled down on this last year. I think in the interest of time, we won't, but you can see the link there that gives you an example of what a Form 990 looks like. It's very extensive, folks. It used to be not so much 15 years ago, but recent changes have required additional disclosures. Simple things that include the description of your mission, but multiple questions regarding disclosures and governance practices. Required to list out key employee compensation. When these 990s are posted to GuideStar, sometimes what folks do, or potential investors do, is to go out to see how much is the institution spending on program costs versus management expenses. So a donor is typically interested in seeing a greater percentage spent on program versus the day-to-day management of the institution. But those are very clearly segregated on a Form 990. Schedule of contributors. We have to require names and amounts that we file with IRS, but a public 990 document does not require those names to be disclosed. Includes tax-exempt bond information and transactions with interested persons. So if you have a member of your board with which you do business, that those types of things are disclosed on the 990 as well. Lots of information there. Next slide, please. Just a little bit on performance trends and benchmarks. Really important. Every October, our board of directors asks each of our committees, liaisons, to assemble for them benchmark data comparing us to a defined list of peer institutions. So here at Valpo, we have a list of peer institutions that is 26 institutions long, and we include every one of those 26 peers in all of our data and benchmarking that we do as compared to our own performance. And then our own performance year over year is also very helpful. And then we do, we pay attention to that composite financial index, or CFI. I'm going to talk about that in a minute. The Department of Education financial score, which you see from time to time in the headlines. And then again, if we're using the same book, there was a great ratio analysis section in that book that highlighted for you some red flags. So I just suggest you take a look at that too. So let's go ahead and next slide. This is a CFI that I referenced on the previous slide. We use this. This is a really good general measurement of the financial position of an institution. So we're going to talk through this a little bit. So what we're looking for is a score that goes from -1 on the left-hand side of the scale to a 10. You want to have a higher rather than a lower score. What these numbers mean at the end of the day are defined pretty much, or gives you a general idea by those green arrows that you see. So for instance, if you have a CFI score of -1 to 1, you're having a hard time surviving. The viability is in question. If you score between 0 and 3, it's very likely that you're either in re-engineering discussions or should be in re-engineering discussions, because what we're doing now is not working. If you're a 2 to a 5, you're directing institutional resources to allow for continual transformation. And then 4, 5, 6, 7, you're doing all right. The focus is on competing in a future state, and ultimately it would, I would say be great to be a 6 to a 10. I can tell you at one point Valpo was a 7. Is not the case today. In the more competitive times, we've slid down on that scale. But that composite score is 4 different ratios. They look at financial flexibility, operating performance, overall performance, and then your ability to cover debt to get that one financial score. One more thing to watch here is, that CFI is a measurement, again, as a point in time. What our auditors say to us is it's really probably more important to look at trends and look at a 3-year score, because think about it, particularly if you have a decent sized endowment, some of your score will be impacted by whether or not the market was up or the market was down, or if you're in a campaign or if you're not. So a 3-year trend is helpful when analyzing the CFI score. Next page. The DOE, not DOA, Freudian slip, financial responsibility score. This is the piece that we tend to see in Inside Higher Ed or the Chronicle, particularly related to institutions who fail to meet the minimum score. So it's designed to measure the fiscal stability of a college which accepts federal financial aid. So the government is saying, hey, at the minimum we have these expectations from you from a financial perspective, and gives them reassurances. So it incorporates 3 ratios. In this case, it's the primary reserve, equity, and net income ratios. And what we're looking for here are composite scores from -1 to a 3. So you can't get higher than a 3 for the DOE score. If you score between 1.5 and 3, that's an indication that the institution is financially responsible in the view of the DOE. If you score between 1 and 1.5, there's additional monitoring that takes place. And I think that the really problematic pieces are when you move into to a -1 to a 1. But again, 1.5 is what you're looking to score on a DOE responsibility score or higher. Next page. Moving, we just got a couple more slides, so hang with me if you can. Again, just to talk a little bit more about those structural and cultural challenges, and you may be already, in the thick of things and well aware of these, but I think I took most of these bullet points from actually an AGB webinar that I listened in on last year. And what they were trying to hit home on is that, higher ed will not be immune to sector failure. So when we think about what Amazon has done to the retail markets and department stores and the like, they're saying, higher ed's not immune to that. We need to pay really close attention to technologies and trends in order to remain viable. They also pointed to the natural rhythm of higher education cycle being a challenge during times when you need a quicker response. And what does that mean exactly? Well, we have an academic year, so there's a real rhythm to, that cycle and, expectations of what goes on in that cycle. And in that academic year, as opposed to a for-profit corporation, you've got, some folks have summers off. We have maybe extended Thanksgiving or Christmas downtime, spring breaks and things like that don't occur outside of higher ed. We have commitments to faculty and staff. So this is sort of a reference to tenured faculty. Typically, if an institution finds itself in a position that it needs to pull back on programs, that's going to impact faculty. There are notification requirements. Sometimes it takes 2 to 3 years to let a tenure track faculty member go. So that becomes difficult. Shared governance is a wonderful thing. Usually there's some really great outcomes because you have, some really great minds in a room thinking through a problem. The challenge with that is it can be slow. And again, in an environment when you need to be fast-paced and change quickly, that can be a detriment to moving forward quickly. And then finally, that reference to endowment, you might, scratch your head on that one. But remember, the cash is king sort of reference. And what I said to you about when institutions fail or when businesses fail is typically at the point that they run out of cash and they just can't survive any longer. Well, I think that for us, if we have endowments, there's that, it is true that endowments are there to support us in those really challenging times, but the challenge is in that it's a false sense of security that it's not an unlimited source of funding. So I think that's what the point trying to be made there. So again, need more of a bias towards action in challenging times. We need to make sure we have expertise to respond to the rapidly changing environment. Need to focus on revenue diversification, maybe alternate program delivery, so whether it's online or a hybrid programs, bringing in more of that auxiliary revenue, perhaps renting out excess capacity. All of those things you need to think through in terms of revenue diversification so you're not as reliant on net tuition revenue. And then finally, the thought is, and I think we see this more and more, conversations about contractual partnerships, mergers, acquisitions, and so on. You're seeing that much more in the higher ed sector than we've seen previously, and likely to continue. Next slide, please. This is the last slide I'm going to leave you with. So again, admittedly, lots of challenges, probably lots of opportunities as well as we move through this period of stagnation in terms of the number of high school graduates. Tom referenced earlier that I'm actually president of Kakubo this year. When you serve on the Kakubo board in the leadership track, you also become a member of the National Association. So I'm also on the Kakubo board and have worked with them on what they recently completed is called an economic models project. And that's the piece that I encourage you and others at your institution to explore. If you're interested in learning more about how signs to look for in terms of financial stresses, things that can be done to to help maybe right the ship. Lots and lots of resources out there. There's a library of information, white papers and data that can be used to help navigate, I think, during challenging times. So I'd hope to share that with you, but our technology is not optimal today, but I encourage you to go out there and take a look at that. And then the other two, the Association of Governing Boards typically has lots of great information, and the Council for Advancement of Support of Education, that's the case, that's the advancement people, folks. They typically use their guidelines in terms of their fundraising efforts. So that is the end of my presentation. So again, happy to take whatever additional questions or comments you might have at this point.
Susan, I'll set up and change on this slide that needed changed. It was particularly the second piece, increased balances without plausible explanation, particularly X and Y, not cash and investments.
Notes and bonds payable.
Yeah, that's what I thought. Okay.
Yeah. Good, thank you.
And then I'll get those out. And for the folks that are still with us here, the book that we both mentioned, and if you just want to put it on your bookshelf to be intimidating, it can be useful to have there, just so when people walk in, first of all, it's red and white, and I'll send you this reference. It's called Financial Intelligence. And it's a great non-CFO, non-MBA, non-CPA way. And it gives you, what I really appreciated about it is when the auditors come, you need to know what questions to ask, right? And you don't want to sound like a dodo brain. So this thing really helps you. I mean, you're still not a CPA or a CFO, but it at least helps you understand the variables, right, Susan? I think that's really the important thing.
Yeah.
Sometimes this stuff looks so prescriptive.
Yeah.
But in another sense, there are some little leeways here and there about how you report some of these things.
Yeah, I think it's really helpful. It's readable, it's understandable. And I think the funny thing was that you and I both used that book and didn't know it until we started talking.
Yeah.
So, yeah.
So I'll put that reference in also when we send you out the notes with this.
Yeah.
So it's so important to really understand how this all fits together. And as you all move through your careers and your lives and your vocations, you're going to hear more about everything but cash flow to discount rates and understanding what that all means. And yeah. Sorry.
Yeah.
Any other questions? If not, Susan, thank you tons as always.
Yeah.
We appreciate it. We'll get the video here. And Steve and I got some things I got to talk to you about anyways. So, and this takes a while to process. Actually, it goes through some wacko processing thing. So once it's done doing that, we'll talk about that. But otherwise, thanks, Susan.
Yeah, thank you all for your attention today and good questions. I appreciate it. And best of luck to everybody. And nice to see you, Tom.
Okay.
Thank you very much.
Bye.
Shutting it down.